All right, guys, welcome back for another video. In today's video, I want to talk about price extensions and price extensions within the context of liquidity and inside gaps. One, common behavior that price makes is, whenever you break a low, price will come back, fill the extension, and that's a tradable level, right? And it's also a very good risk management level. So you can take a short here, and you can also use whatever high is created there as a risk management level. And that's the context of liquidity that we were talking about. So typically, uh, this is tradable. You don't know how far it's going to go, so you need to start taking profit below, at these lows or somewhere below these lows. And then on the flip side, right, if you especially if you see price fill an extension, come down, come back into the range, and then run up above the highs, this is an apex now. So it went from a price extension into an apex formation, and that's where you'd want to put your stop. You can see the same thing here, just to the downside. So price comes up above here, fills the extension, and then you can, once that low is violated, then price pushes lower to lower distinctions down here. Again, you didn't get the liquidity run like you did here, and that's why it didn't move as violently. When you see the liquidity run, that is a major red flag. Let's see. So here's another example right here. So you get a price extension right here. Price comes up, fills the extension. That's a tradable level, comes down at these lows, sell the lows. Now you get a liquidity run below the lows. And if price comes up, trades above these highs, now you have a very distinct tradable level, or invalidation level, I should say. Same type of deal here, only this is a little bit higher time frame than a 15-minute, but still the same idea, right? Price comes, fills the extension. Once that level is reclaimed, then price moves much higher towards levels much further upward. Let's see if we can find some more. Let's see. All right, essentially you got the distinction right here. You got your price extension right there. This is not a great example just because the price extension really didn't sell off. You just get consolidation at resistance. Price moves up. Here's a good example as well. Well, doesn't hit the price extension exactly, but front runs it a little bit. Let's see. Okay, here you go. Here's another example. Price sells off, fills the extension. The extension is a tradable area. Not only is it a tradable area, but it also offers a good invalidation level. So now you got to keep in mind how low of a time frame this is, right? So that's why you need to manage equity right away when the trade starts moving in your favor. So price sells off, and then you can take some profits down here if you were in a short position. And then by the same token, this level offers a very good invalidation level. You can see here, price moves through it distinctly. You'd want to have a stop there. Also comes down, trades off it. That's a tradable level as well. And this is a little bit more of a data release level. So, this is a little bit of noise in here. Okay, here's a good example as well. Again, this is not perfectly clean, but price comes down here, fills the extension, sells off. Once it's reclaimed, price mounts a rally upward. Same idea here. So price comes up, fills the extension. Once that level is reclaimed, price pushes very aggressively downward to retrace. And so the flip side of this is that, if you do have say you were in a short position from these highs, you really want to be managing risk on that short position when price retests this level, because price could retest this level and um, just go march up higher. You really don't know. Now, of course, it didn't do that. It came down and violated these levels. But it's very important to understand this price distinction, because it helps for managing risk, and extremely, extremely valuable in understanding how to manage risk on any trade, right? If you're long or if you're short. Um, and it also gives you the framework to understand when volatility might expand, right? So when price comes down and tests this level, it gives you a reaction. Um, it is a very tradable reaction, but there's a distinction between the first time that it tests this level and the second time, right? So when price comes down and tests this level for the first time, it offers you a long position, but you don't want to buy it on second pass, right? On second pass, it has a very different distinction, right? You want to be using it to manage risk rather than add risk. And that's a very important concept to understand. It's very nuanced, but I thought I'd do a video on it just to, you know, see what you guys think. Anyway, if you guys like this content, just make sure to subscribe to the channel. Definitely helps us out. Make sure to like the video, and